I got to farm with my dad every day. It's a way of life. It's a wonderful way of life. And it's at risk. And it shouldn't be.
The impact of Trump's tariffs is being felt in the heartland.
Soybean farmers here are now suffering economically like they haven't in decades.
Right now, we are harvesting soybeans in Marengo, Illinois. My family has been farming since 1846. I'm the fifth generation.
They never saw it coming, not from Africa, not from the continent they thought would always receive, never refuse. But this time, the tables turned. A decision quiet at first has just sent tremors through Washington's trade corridors. African nations have blocked $124 billion worth of U.S. soybean exports. And while the mainstream headlines try to bury it under phrases like market realignment or agricultural policy shift, make no mistake, this is a political earthquake. Let's rewind. For decades, the U.S. has used agriculture as leverage food diplomacy, they call it. From soybeans to wheat to corn and cotton, America's export machines have long fueled not just global trade, but global control. Soybeans especially became the quiet weapon, a crop worth hundreds of billions, feeding livestock, powering industries, and dominating global markets, and Africa, once seen as a growth opportunity, was the next frontier. U.S. lobbyists called it the African Food Corridor, development banks branded it agricultural cooperation, but behind the polished words was one simple plan: turn Africa into a guaranteed market for U.S. farm surpluses while keeping African farmers dependent. Then came the twist. In 2025, a coalition of African nations led by Nigeria, South Africa, Kenya, and Ghana made a bold move that stunned the West. They didn't announce it on CNN or Bloomberg. They simply said no more to the flow of subsidized American soybeans flooding African markets. They chose instead to buy from within the continent, building a pan-African agricultural supply chain. A system where African farmers feed African industries, not the other way around. Washington's response? Confusion, then outrage, then silence. Because this wasn't just about soybeans, it was about sovereignty. For years, U.S. agribusiness giants like Cargill, Archer Daniels Midland, and Bunge treated Africa like open ground: no tariffs, no competition, no real pushback. They poured in cheap, genetically modified soybeans, undercutting local farmers who couldn't compete with Washington-backed subsidies. The result? African soybean industries struggled to take off, local processors shut down, and dependency deepened quietly, structurally, systemically. But the new Africa, the one rising from trade agreements like AfTA, the African Continental Free Trade Area, decided that had to change. Under AfTA, African nations started asking real questions. Why import what we can grow? Why enrich American farmers while our own people struggle? Why should our food security depend on foreign policy moods in Washington? And so, the decision came: $124 billion in contracts paused. Ports that once welcomed American ships redirected to local and regional suppliers. African cooperatives, backed by new agro-industrial financing from the African Development Bank, stepped in to fill the gap. The symbolism hit harder than the numbers, because for the first time in modern trade history, Africa wasn't waiting for permission. It was dictating the terms, and that scares Washington. Soybeans may sound small in the grand theater of geopolitics, but here's the catch: they're a cornerstone commodity. They feed the meat industry, the oil industry, even the biofuel sector. When a $124 billion flow gets blocked, the ripple hits Wall Street, not just farmlands. U.S. farm lobbies went straight to Congress. How could Africa do this? They asked. But the truth is, Africa didn't just do it. Africa earned the right to do it. After decades of exporting raw minerals, raw cocoa, raw coffee, while importing processed goods, this was more than economic defiance. It was a message: we are no longer the field, we are the factory. Look deeper, and you'll see who helped fuel this shift: India, China, Brazil. They invested quietly in Africa's agricultural processing zones. They funded local mills, soybean oil plants, and biofuel refineries. They helped turn African farmers into producers, not just growers. And that is why Washington's silence is so loud, because the U.S. didn't just lose a customer, it lost influence. African analysts are calling it the soybean moment, a defining pivot in the continent's economic independence. It's not about anti-America sentiment, it's about balance, dignity, and self-determination. When you produce your own food, you control your destiny. When you process your own crops, you control your wealth. And when you decide who trades with you, you control your power. So yes, $124 billion is a big number, but what's bigger is the message behind it. Africa is done playing the background role in the global economy. Africa is building, producing, and protecting its markets. Africa is no longer waiting for permission to prosper. As the U.S. scrambles to respond, the new African narrative is already unfolding. Soybean fields are expanding from Nigeria to Zambia, Pan-African logistics routes are connecting farms to factories, local soybean oil brands are replacing imports on supermarket shelves, and suddenly that $124 billion loss for America looks like a $1 trillion opportunity for Africa. This isn't just a trade story. It's a shift of consciousness. A continent realizing its economic muscle and flexing it unapologetically. Washington can lobby, complain, or pressure, but Africa has already moved on. The world's youngest continent is no longer asking for aid, it's asking for respect, because when Africa blocks $124 billion worth of U.S. soybeans, it's not just saying no to imports, it's saying yes to itself.
When the world first heard that Africa had rejected $124 billion worth of U.S. soybeans, many dismissed it as symbolic a temporary trade dispute, but they underestimated Africa's long game. This wasn't a tantrum, it was a transformation, because behind the headlines was a silent revolution, one that had been building for years in the soil, the factories, and the financial institutions of the continent. Long before Washington realized what was happening, African economists and agritech innovators were quietly redrawing the map of food independence. The idea was simple but radical. If Africa can feed the world, then why can't Africa feed itself first? This question sparked a wave of investments across the continent. In Nigeria, the government launched the Soy Independence Project, targeting 10 million hectares of high-yield soybean farms. In Ghana, solar-powered processing plants turned rural cooperatives into exporters. In Kenya and Tanzania, universities started training a new generation of agro-engineers, Africans who understood not just how to grow soy, but how to turn it into oil, animal feed, and even biofuel. And in the background, a powerful network was forming, one that Washington had never anticipated. Enter the Pan-African Agro-Alliance, PA, a coalition of 22 nations dedicated to building intra-African food supply chains. No press conferences, no fanfare, just quiet, coordinated action. They pooled resources, shared research, and linked local currencies through the Pan-African payment system, PAPS, bypassing the dollar completely. For the first time, African nations were trading soybeans, corn, and grains in their own currencies, not the greenback. And that's when the game truly changed, because every dollar Africa refused to use weakened U.S. leverage. Every soybean grown on African soil reduced dependency. Every transaction through PAPS was a statement of economic freedom. Funding came not from the IMF or World Bank but from within. The African Development Bank, the BRICS New Development Bank, and even private African tech billionaires began backing agro-industrial corridors stretching from Senegal to Ethiopia. India and China stepped in not as controllers but as partners. They offered machinery, irrigation systems, and seed technology and resource for knowledge exchanges. Unlike Western loans wrapped in political strings, these were deals built on production, not politics. By 2025, Africa had its own soybean exchange platform, trading futures between Nigeria, Zambia, and Mozambique, a financial ecosystem independent of Chicago or New York. For decades, U.S. agribusiness controlled Africa's soybean narrative through subsidies and marketing. American soybeans were cheaper not because they were better, but because Washington paid farmers billions in subsidies to dump excess production overseas. But when African nations stopped importing, those same subsidies became useless. Within months, U.S. soybean prices crashed. Farmers in Iowa and Illinois flooded the government with complaints. The White House scrambled to find new buyers in Asia, but even there, Africa's new trade links with India and Brazil had already filled the gap. For the first time in modern U.S. history, Africa had triggered a trade tremor without firing a shot. At the heart of it all were the farmers. Small-scale producers across Africa, once ignored, once dismissed, suddenly became the backbone of a new economic order. In Mali, farmer cooperatives adopted drone-assisted crop monitoring. In Sudan, water-efficient irrigation turned desert land into fertile fields. In Zambia, local biotech labs produced African-engineered soybean seeds resistant to pests, adapted to African climates, and free from foreign patents. These weren't aid projects, these were power projects. And as production grew, Africa not only fed itself, it started exporting to Europe and the Middle East, this time on its own terms. Washington's response: officially diplomatic restraint, unofficially panic, because the implications went beyond agriculture. If Africa could coordinate on soybeans, it could coordinate on oil, cobalt, rare earths, gold, and gas. If Africa could reject U.S. soybeans, it could one day reject U.S. sanctions. And that is the nightmare scenario. Washington can't control a self-sustaining Africa that no longer needs permission to prosper. Behind closed doors, reports leaked from the U.S. Department of Commerce describing Africa's soybean blockade as a strategic trade threat. Analysts warned that if similar unity extended to other sectors, it could cost America trillions in lost influence over the next decade. But what could they do? Sanctions? Impossible. Africa's markets are too interconnected with BRICS. Too late, the narrative had already shifted. Aid threats. Irrelevant. Africa wasn't begging anymore. The soybean standoff sparked debates in capitals worldwide. In Brussels, European ministers scrambled to sign new trade deals directly with African soybean producers. In New Delhi, India celebrated its processing plants now sourced soy from Ghana and Mozambique instead of the Midwest. In Beijing, China smiled quietly, seeing a world finally moving beyond the US-centric order. For the first time in decades, Africa was the price setter, not the price taker. And global economists admitted something they had long avoided saying aloud: the balance of agricultural power is shifting south to Africa. This isn't just a story of soybeans, it's a blueprint. Africa's model is spreading fast. Rice in Senegal, wheat in Ethiopia, corn in Tanzania, cassava and palm oil in Nigeria, all now moving through localized trade systems under AFTA. The principle remains the same: produce locally, process locally, trade continentally, export globally. It's a four-step revolution and it's unstoppable. What Washington called protectionism, Africans called protection of their people, their markets, their dignity. What the West saw as trade disruption, Africa saw as liberation. Because in truth, this was never about soybeans. It was about power, narrative, and ownership. For generations, Africa's wealth left its shores while poverty stayed behind, but not anymore. Now the wealth, the production, the decision-making is staying home, and that changes everything. So when you hear Western analysts panic about Africa's soybean blockade, remember this: it's not a blockade, it's a beginning, the beginning of a self-sufficient continent, the rise of an economy that refuses to be exploited. The moment Africa stopped being a market and became a maker, because what Washington isn't telling you is that this isn't just a trade story, it's the end of agricultural colonialism, and the dawn of African control. The shockwaves didn't stop at Africa's borders. They rolled across oceans through trading floors in New York, Shanghai, Mumbai, and Sao Paulo. It began as a trade story, but within months it became a crisis of confidence for the global economy. Because when Africa, the world's youngest, fastest-growing continent, decides to change the rules of trade, the world has to listen. Soybeans were never just crops. They were the lifeblood of American Agrippa, were a trillion-dollar system built on control, contracts, and currency. Every deal in soy meant dollar dominance. Every African import was another thread in Washington's global web. But once Africa blocked $124 billion in U.S. exports, that web began to unravel. Wall Street noticed first. Agricultural futures for soybeans plunged by 17% in a single quarter, the sharpest drop in 20 years. Farm lobbyists went into overdrive, begging Congress for emergency relief, but even billions in subsidies couldn't hide the truth. The U.S. no longer controlled the world's agricultural narrative. African nations, united under AFTA, had redrawn the map. They were trading with one another and winning. Suddenly, U.S. dominance in grain, corn, and soy markets wasn't guaranteed. Washington's fear wasn't losing sales, it was losing leverage. The aftershock spread fast. Europe, long reliant on American soy imports, turned to Africa for alternatives, attracted by cheaper logistics, sustainable farming models, and untapped partnerships. Brazil and India, once U.S. rivals in agriculture, aligned with Africa, forming what economists now call the Southern Triangle of food power. For the first time in modern trade, the global South became the center. Africa's new soybean corridor, stretching from Senegal's ports to Kenya's highlands, became the backbone of a food network feeding over 2 billion people. China quickly joined in, signing multi-billion-dollar contracts with African suppliers under the Green Silk Road Initiative. In less than a year, Chinese processors replaced 40% of U.S. soybean imports with African alternatives. That's when Washington realized this wasn't just lost trade, this was lost control. For decades, every major food trade was settled in U.S. dollars. But when Africa moved its trade into PAPS, the Pan-African Payment and Settlement System, it didn't just block soybeans. It blocked dollar dependency. By 2026, over 40% of intra-African food trade was settled in local currencies or digital trade credits. Countries like Nigeria and Kenya began experimenting with commodity-backed digital coins, pegged to real harvests instead of U.S. Treasury bonds. The implications were massive. If Africa could trade without the dollar, others could too, and they did. Indonesia, Saudi Arabia, even Argentina all began exploring Africa-style regional payment systems. Washington could feel it. The world's financial architecture was shifting, and it started with a soybean inside the Pentagon's Global Security Review. Africa suddenly appeared not as an aid recipient but as a strategic variable. Because control of food systems means control of people, politics, and peace. When the U.S. lost its agricultural grip on Africa, it lost one of its soft power pillars, the quiet control mechanism of dependency. For years, U.S. food aid had come with conditions: open markets, favorable contracts, military cooperation. But now, African nations could say no, thank you, and mean it. The result: a diplomatic reshuffle unlike anything seen in the 21st century. U.S. delegations rushed to renew partnerships in Abuja, Nairobi, and Pretoria. But their language had changed from instructional to respectful. From "you need us" to "we'd like to work with you." It was subtle but historic. While Washington debated strategy, Africa was busy building the future. Nigeria's Kaduna Belt became the heart of Africa's soybean oil production, exporting refined oils to Europe and Asia. Tanzania's Smart Farms initiative linked AI, drones, and weather prediction to triple yield efficiency. Ghana's Africa Agri Hub trained 100,000 young Africans in agritech, turning the next generation into food entrepreneurs. Zambia emerged as Africa's Silicon Valley of seeds, designing patented, climate-adapted soybean varieties owned by Africans for Africans. The continent's GDP from agriculture soared. Local industries flourished, and millions of jobs emerged not in extraction but in production. The dream of self-sufficiency was no longer theoretical. It was real. Washington tried to strike back. They launched a PR campaign branding Africa's trade realignment as anti-globalization. They offered new aid packages wrapped in climate-friendly agriculture. They even proposed trilateral deals, US-Africa-EU partnerships, hoping to reclaim influence. But it didn't work, because Africa's answer was clear: partnership. Not paternalism. US corporations could no longer dictate prices, terms, or markets. African cooperatives and sovereign funds were setting their own. The U.S. Soybean Export Council called it the biggest trade shock of the decade. But to Africans, it was simply economic independence long overdue. Across the global south, Africa's stand became a symbol. In South America, farmers demanded sovereignty over crop exports. In Southeast Asia, nations started rethinking Western agricultural dependence. And in the Middle East, sovereign funds poured billions into African farmlands, not to exploit but to partner. Africa had become the blueprint for post-Western trade, a model of cooperation without coercion. Let's talk numbers, the ones buried under sanitized reports. In just 2 years, Africa's soybean exports grew by 78%, while U.S. exports to Africa fell by 91%. The U.S. lost $124 billion in direct trade, but an estimated $420 billion in indirect influence. The dollar's share of African trade settlements dropped from 84% to 53% in under 18 months. African agricultural employment rose by 12 million jobs continent-wide. Behind every statistic is a statement. Africa is not rising. Africa has risen. Let's be clear, this wasn't revenge. This wasn't anti-Americanism. This was economic self-respect, the right to feed one's people and profit from one's soil. For centuries, Africa's raw materials built foreign empires. Now its farms are building African ones. That's what Washington isn't telling you. That's why this story rarely makes global headlines. Because if Africa can win at soybeans, it can win at anything, from lithium to cocoa, oil to innovation. The precedent is set. So when historians look back at 2025, they won't just see a trade blockade. They'll see the moment Africa reprogrammed the global economy. A quiet revolution born in the soil, powered by unity, and led by a generation that refused to be told its limits. Washington lost more than money. It lost the narrative. And in this century, narrative is power. Because the world no longer looks to the West for permission, it looks to Africa for inspiration.